Nearly 3,000 ETFs and closed-end funds are available in the stock market in the US. Which ones are better for your portfolio and how to find them? My name is Hoda Mer. I am founder and CEO of Stock Carc, and I used to be against investing in ETFs. However, quite recently, I've changed my mind, and now one ETF alone is my biggest holding. Initially, my logic was that if I liked an ETF, I would buy the top stocks in that fund and don't have to pay a fund manager that I didn't know some fees to do what I could do better at no cost. I also found it very difficult to evaluate ETFs because I wanted to research each individual holdings in that ETF to feel comfortable about investing in it. But that approach was impractical. ETFs tend to invest in many different things, including stocks, bonds, and other types of assets, making it hard to research the ETF by researching its individual holdings. For example, there are nearly 500 ETFs in the US with more than 500 holdings. How do you research and track 500 stocks, bonds, and other assets to invest in one ETF? To evaluate an ETF, you need a different model than the model you use to research the stocks. And today, I'll introduce 3 such models to find the top ETFs to invest in. You may also change your mind about investing in ETFs as I did. Like any other successful investment, you first need to know why you invest in any particular fund. Are you investing in it because you want to get reliable dividend income? Or are you investing because you want to add a basket of high growth stocks to your portfolio instead of picking and dealing with several volatile high growth stocks? Are you investing in ETFs to gain exposure to assets you either don't have access to or you wouldn't normally invest in because they're out of your comfort zone, such as cryptocurrencies, shorting the market, or distressed debt? Those are very different strategies and great reasons you would invest in an ETF instead of picking individual holdings of that fund. So I structured this episode to go through the top 3 investing ETF models, which are diversification, dividend income, and growth. After discussing each model, I'll give you a link to download the list of such ETFs, and you get a chance to create your own personalized ETFs investing model and find the top ETFs to invest in now. As a reminder, I'm not a financial advisor, and this episode is for education and entertainment only. Find a fee-only advisor who can help answer specific questions about your personal portfolio, or better yet, learn to do it yourself. The first one of the 3 models is investing in ETFs for diversification. Diversification is the most common reason folks invest in ETFs. The logic is that you get immediate diversification because ETFs invest in several holdings. While that's true in some cases, it doesn't apply to all funds. Some ETFs invest only in one thing. For example, take Grayscale Bitcoin Trust, ticker BTC, and if you look at its top 25 holdings, there's only one thing in it, Bitcoin. If you're looking for diversified ETFs, you need to make sure the fund meets certain criteria. First one, it has to have many holdings. For the diversification goal, I would go as far as choosing funds that have at least 250 holdings. That's because funds like that tend to be index funds, meaning that no active stock picking is happening in the fund, giving me an immediate broad diversification. And that brings me to the second criteria, the management fee. If an ETF has at least 250 holdings, there is no way a team of analysts is behind that fund researching every 250 holdings in that ETF. That is a very expensive ETF running operation. In most cases, the fund manager is mirroring or copying an index created by someone else. In other words, the cost of running that ETF has to be very low, and the fee you pay to the fund manager has to be as low as possible. The third criteria is the fund's risk level. If you're diversifying, it means you're giving up a higher return for a chance to smooth out your risk. You need to look for ETFs that have low risk. Risk in ETFs comes from borrowing money to invest, betting against things, or investing in very concentrated lists of assets. When you invest in ETFs for diversification, you'd want to avoid such risky behavior by the fund manager. And lastly, you want an ETF that gives you at least the same return or higher return than the market, because the entire purpose of diversification is to slowly and smoothly generate similar or slightly higher return than the market. As I was talking to you, I also screened the market based on those criteria, and there were several funds in this screener result at the time of recording. I leave a link in the description so you can download this list or change the criteria to your liking. For example, if you want to diversify by limit your exposure to a specific country or region, you can play with it and then save the screener for yourself. The next model for investing in ETFs is for dividend income. This is another of the most common ETF investing strategies among retail investors, especially because unlike stocks that tend to pay quarterly or annual dividends, many ETF managers use a combination of equity investing and call options to pay monthly dividends that investors can use to pay the bills. QYLD is one of the favorite ETFs that pay monthly dividends, as an example. How do we find top ETFs similar to QYLD? The first and the most obvious factor is that the fund must pay dividends. It also has to pay at least a 5% dividend, so your investment results in a meaningful amount. A $10,000 investment in a 5% dividend yield ETF means about $40 a month that you can use to pay off some bills. Anything lower than that is really insignificant unless you invest millions. I suggest a 5% or above dividend yield for the current and forecasted dividend yields. Other important criteria for the dividend income ETF investing model is the fee you pay to own high yield dividend ETFs. Logically, we prefer to pay less for fees. However, low fees always come at a cost. If you look for a low fee fund, likely you can't get a high dividend yield. Most high yield dividend paying ETF funds that pay about 5% tend to use derivatives like selling call options to generate that income. So you pay a slightly higher fee, which means something higher than 0.5%. Also, because we have to pay taxes on the dividend distribution received, these ETFs tend to have high tax costs. You can't have both. You pay high fees and get higher yields, or pay lower fees and accept lower yields, and you lose some of the best dividend paying ETFs if you only filter for low tax and low cost. Here, I'd suggest relaxing your fee criteria, allowing funds with reasonable fees, and disregarding the tax cost impact. Again, I save my high yield dividend ETF screener link for you in the show notes. You can save it to your own Stock Carc account and start adjusting it to your own liking or add it to your watch list. The last ETF investing model to discuss is the one I like the most, investing in ETFs for high growth by exposing your portfolio to highly concentrated investment opportunities that either you wouldn't normally invest in, or it takes a lot of effort to replicate such an investment model on your own. One example is investing in high-yield corporate bonds. Typically, investing in one of them requires a $5,000 minimum investment, and many new brokerage apps like Robinhood don't offer them. It's a hassle to invest in what's been known as one of the most successful investment strategies. For example, Howard Marks is an investor in high-yield corporate bonds or companies with distressed debt. But as we said, investing in such assets is a hassle for you and me. The good news is that with the creation of bond ETFs, we have several high-yield corporate bond ETFs available. For example, iBox High Yield Corporate Bond, ticker HYG, is one of those high-yield corporate bond ETFs worth researching. Beyond distressed debt and corporate bond ETFs, I told you that one ETF that has the highest weight in my personal portfolio, and I picked it using this ETF investing model. It's a super concentrated ETF with a lot of volatility and risk that I bought to add upside and high growth potential without spending too much time researching and tracking individual stocks. As a side note, if you are a VIP user on Stock Carc platform, you can follow my personal portfolio, and chances are you already know this ETF. But I digress. To find such ETFs for growth, firstly, you have to go after funds with a small number of holdings. Remember, high growth comes from concentration. Secondly, you have to focus on funds that invest in a specific sector that is also growing rapidly. It can be as broad as investing in sectors such as technology, or as niche as investing in themes such as gene editing. Once again, growth comes from concentration. But not every concentrated fund is worth investing in. When you are picking ETFs for growth, most importantly, you focus on ETF fund managers willing to take some, but still reasonable risk. I'm not too fond of super high risk ETFs because they tend to be fund managers who borrow a lot of money to boost their return or short some things. I am generally not comfortable with that or shorting risk. You may be so. But for me, I stay in the reasonable risk category. Put concentration and reasonable risk criteria together, and the result is a small list of ETFs worth considering if you'd like to add upside potential without researching too many individual stocks. Once again, I leave a link to this ETF screener that helps you find concentrated ETFs for the upside so you can save and customize it to your own personal criteria. So today we talked about 3 ETF investing models, and I shared 3 screeners that help you find top ETFs to invest in now using each model. The link to them is in the show notes. If you end up using the screener tool on stockcarc.io, which by the way is free to use, and create new ETF screeners for other ETF investing models, share a brief description of your model and the link to the screener in the comments so we can all learn from you. That's it for today. I am working on my next 100-bagger stock analysis episode, which should come out soon. Until then, watch the previous episodes of the 100-bagger stock analysis using the 100-bagger series on our YouTube channel. You guessed it, the link is in the show notes. See you soon.